than Phil. I worked for Ben. I went to school under him, and his what I call the three basic ideas that underlie successful investing, which is to look at stocks as businesses and to have the proper attitude toward the market and to operate with a margin of safety. They all come straight from Graham. I didn't think of any of those. And
The Intelligent Investor is arguably the most well-known investing book on the planet. First published in 1949, the book is highly regarded and has laid the foundation of what is referred to as value investing. The greatest investor of all time, Warren Buffett, read this book when he was only 19 and says the book changed his life. He credits the book for laying the foundation of his investment strategy. This investment strategy helped Buffett go on to be one of the most highly respected investors and business people ever. At 640 pages, this book is not a light read. So I decided to read the entire book for you and summarize the most important points. All I ask in exchange is for you to hit the like button because I love helping people learn about investing. Make sure to stick around to the end of the video because I guarantee it will make you a better, smarter investor. Now let's dive into the video. It is no secret that this book is old, and some of the formulas and advice are outdated. But with that being said, there are 2 chapters in this book that are considered to be foundational for an individual to truly understand investing. Those are Chapter 8 and Chapter 20. I use the knowledge I gain from these chapters every day at my job as an investment analyst at a large investment firm. But don't just listen to me. Here's what Warren Buffett had to say. Chapters 8 and 20 have been the bedrock of my investing activities for more than 60 years. I suggest that all investors read those chapters and reread them every time the market has been especially strong or weak. Chapter 8 introduces the concept and story of Mr. Market. Graham says that one of the biggest advantages an investor has is that he or she is rarely ever forced to sell his shares. An intelligent investor only pays attention to the current stock price when it suits him. The investor who permits himself to be worried by unjustified stock price declines in the stocks he owns is essentially transforming this huge advantage into a significant disadvantage. Graham wrote, quote, "Imagine that we own small shares in a private business that costs us $1,000. One of our partners is called Mr. Market. Mr. Market is a very obliging partner. Every day, he tells us what he thinks our interest is worth, and furthermore, offers either to buy us out or to sell us an additional interest on that basis. Sometimes his idea of value appears justified and plausible by business developments and prospects as we know them. Often, on the other hand, Mr. Market lets his enthusiasm or his fears run away with him, and the value he proposes seems to you a little short of silly. If we are a prudent investor or a sensible businessman, will we let Mr. Market's daily communication determine our view of the value of a $1,000 interest in the business? Only when we agree with him or we want to trade with him. We may be happy to sell out to him when he quotes a ridiculously high price, and equally happy to buy from him when his price is low. But the rest of the time, we would be wiser to form our own views of the value of our holdings, based on full reports from the business about its operations as well as its financial positions." What Ben Graham explained is exactly what happens every day that the stock market is open. Let's say you own shares in Apple. Every day, you get a price that you could either buy more shares of Apple or sell your existing shares. This price is the trading price, and it fluctuates throughout the day, week, month, and year. Let's say you believe your Apple stock is worth $200 a share based upon your own fundamental analysis of the business. If the current market price of Apple is $150 a share, you don't have to sell because you aren't being offered what you believe the stock is worth. On the other hand, if you believe that Apple stock is worth $200 a share and the market price is $250, you could decide to sell your stock because you are getting more for it than what you believe it is truly worth. The main point of this chapter is that you shouldn't let the movement of a stock price influence what you think the worth of a stock is. You should do your own fundamental analysis of the business and determine what you believe the actual value of the stock is. You should make sure to take advantage of this when there is a disconnect between what the value of the stock truly is and what it is selling for in the stock market. Another key takeaway is that you should not be overly concerned with price declines in a stock that you bought as long as the underlying fundamentals of the business remain intact. Let's say you bought a stock for $100. Based upon your analysis of the company, you think the value of that stock is closer to $150. Shortly after you bought the stock, the price declines to $80 for seemingly no valid reason. A true investor will reassess the business and see if the underlying fundamentals of the business have changed. If the stock is still worth $150 based upon your assessment of the company, you could take advantage of this price decline and buy the stock at a huge discount to its true value. A true investor will welcome this price decline because it means they got the stock of a great company at an even bigger discount than what they initially purchased the shares for. This is what distinguishes an investor from what Graham refers to as a speculator. A speculator looks at the stock price movement to determine the value of a business and whether they made a good investment. In this case, the speculator would likely sell the stock because they think they made a bad investment simply because the price went down after they bought the stock. Once you understand fundamental investing, you understand just how foolish it is to act like a speculator and sell a stock just because the price went down. But isn't this exactly how a lot of people who claim to be an investor behave? This helps explain why many individual investors struggle. If there is one thing to remember from this video, it is to be an investor, not a speculator. Next up is Chapter 20, which introduces what I consider to be arguably the most important concept in investing. That concept is the margin of safety. These three words, margin of safety, are the most important words in the Intelligent Investor book. Put simply, margin of safety in stock investing is the difference between the intrinsic or true value of the company and the price we pay for it. Going back to our previous example, let's say you bought a stock for $100 and the intrinsic value of that stock is $150. The difference between what a stock is truly worth, in this case $150, and what it is currently selling for, in this case $100, represents the margin of safety. In this example, the margin of safety is $50. This means you bought the stock at a 33% discount to its intrinsic value, representing a healthy margin of safety. There are two huge benefits of a margin of safety when investing. The first is that it helps reduce the likelihood of you losing money if the company you bought stock in doesn't perform as you expected. The margin of safety is crucial if you want to follow Warren Buffett's 2 rules for investing. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. When you buy a stock with a significant margin of safety, you are reducing your risk of permanently losing your money. Let's say you invested in a company named XYZ that sells my favorite food, pizza. Let's say you bought the shares in the company for $50 each, and based upon your analysis, each of these shares are worth $100. However, let's say after you bought these shares, the cost of cheese, an important ingredient in pizza, increases dramatically. This means that it now costs XYZ company more money to make each pizza, and assuming they aren't able to raise the price, they make less money on each pizza sold. Because the company is going to make less money, the company's intrinsic value is now worth only $80, a 20% decline from your initial calculation of $100 per share. But notice that even though something negative happened to the company that you didn't expect and couldn't predict, you still bought for a price that is below the new intrinsic value of the company. This example demonstrates the power of using a margin of safety when investing. It helps limit your risk and protect you from losing money when things happen that are impossible to predict. Investors who invest with a margin of safety benefit both from the increasing value of the business as well as the gap between the purchase price and intrinsic value closing over time. The second benefit of using a margin of safety is that it helps you make more money and have better returns if things turn out well. To demonstrate this, let's take two investors. Let's call them Investor A and Investor B. Investor A buys a stock for $50 when that stock's intrinsic value is $100. Investor B buys a stock that is selling for the same price as its intrinsic value, $100 a share. Both investors bought stock with an intrinsic value of $100. The only difference is that Investor A only made the purchase because there is a margin of safety, a significant difference between what he paid for the stock and what the stock is truly worth. Let's say both of these companies that Investor A and Investor B own stock in does well and even better than ever. The companies are able to cut costs and be more profitable. As a result, the intrinsic value of both of the stocks move from $100 to $125 over the course of the year. The improvement in the companies got the stock market attention, and now both stocks are selling at their intrinsic value of $125. Investor B experienced a great return of 25% on his investment. But Investor A, who bought his stock at a significant margin of safety, made an incredible return of 150%. Even though the intrinsic value of both of these stocks increased the same 25% for both investors, Investor A benefited much more from it than Investor B because Investor A bought the stock using a margin of safety. Not only did Investor A benefit from improvements in the underlying business, he also benefited from the discount between what the stock was currently trading for and what its fair value was. This was the reason Investor A's return was so much higher and shows just how impactful a margin of safety can be when a company is performing well. I know learning about investing can be tedious and challenging, so make sure to comment below what other books I should do summaries on. I just truly enjoy talking about investing. My goal is to help you better understand investing. I hope you found this video helpful, and I hope you enjoyed it. Talk to you soon.